Good morning, good afternoon, good evening, folks. Michael Zuber, one rental at a time, back with the one and only Mr. Jonathan Twanley. How you doing, sir?
I'm doing great, Michael. How are you?
I'm doing well. So I just got to ask, we're both in the real estate space. I'm on residential, you're in commercial. Obviously, our industry is very debt or interest rate sensitive. I don't think there is any secret there. We have a lot of people calling for Fed pivots, right? The Fed pivot used to be a cut, then it was a pause. Now people are happy if the Fed just doesn't give us as much pain. We did see the Bank of Australia deliver a 50 when the market expected 75. Canada just gave a 50 yesterday when the market expected a 75. So, Jonathan, is the Fed in the United States going to pivot and give us less than we expect? What do you think?
I don't think so.
Video over.
Yeah, I think the Fed is going to stay the course. Actually, I mean, if you look at Canada, their inflation rate is slightly lower than ours. So they were, I think there was a little bit, room for them to be less aggressive on the rate hikes. I don't know what was going on in Australia in terms of their inflation rate, but if you look at the Eurozone, Eurozone area has got higher inflation than us. And they just did 75 basis points, which is what the markets expected to happen. Correct. They did that today. And I expect like further aggressive rate hiking from the ECB over the next few months as well, because, they've been sub-zero for such a long time. They've got a lot of ground to make up, and their inflation rate is like almost 10%. So, yeah, I mean, it's bad. So, yeah, I think the Fed is kind of in the middle of those two positions, and I think they're just going to stay the course. So until they think that they've gotten inflation whipped, and honestly, I don't think Jerome Powell wants to be the guy who let inflation get away. I mean, who does anybody remember who was the Fed chairman before Paul Volcker? I mean,
I do.
Who was that? What was his name?
Arthur Burns. Mr.
Burns.
Great Inflation. That's his nickname. That's not a nickname you want. Great Inflation.
So,
yeah, that's not what Powell wants.
Yeah, exactly.
So, I think Powell, I think there's two things. Yeah, that scares him, right? Powell's like, hey, I got two choices. I could be Arthur Burns, which for him would be transitory, right? That's what his name, like if his book was written today, it would be called Transitory. He is trying to get that off, erase it, and be called something else. He wants to be Paul Volcker. There's no question. And also, I believe if you gave him true serum, he wants to kill the Fed put. I think the stock market has gotten used to being bailed out, right? They whine like little babies, and they, the Fed comes in and saves them. You can't do that when inflation's at, north of 8%. But yeah, I can't see them giving us 50 when the market expects 75. That would be, man, the market would go bananas if they did that.
Yeah. I mean, that would be bad, right? I mean, it would just, I mean, it would, everybody would be happy,
encourage
right?
behavior, right?
Yeah, right. I mean, the stock market would be ecstatic, but I don't think that's necessarily the right thing for the Fed to do, and I don't think that they will. So, and what's interesting is that we talked before in previous episodes about the risk-free rate of return, right? And this is something that, if you're younger than you and I are, you may not even ever heard this term before, because there was no risk-free rate of return. It was
zero. What is that?
It was
Grandpa?
It was effectively zero. I mean, this morning I was reading about how, insurance companies are pulling back out of the real estate space, right? And why? Why is it? Well, because, I mean, they're interest rate sensitive, and also they have very low, interest rates. Insurance companies are investing in like blue chip commercial real estate, which produces pretty modest returns, right? But very safe. Now they can actually just buy some bonds and get 1.5, right? Which they haven't done in a very long time, right? So, and their expectation is that's even going to go up further. So there is now a risk-free rate of return once again that very conservative capital is going to be very happy to avail itself of. And now any sponsor of a real estate deal has got to beat that return, right?
Yeah. By margin, yeah.
Right, with a risk premium attached to it to account for the different risk that's involved in operating a business like a commercial real estate building. So it's working, right? And I think that having a risk-free rate of return is a good thing for the economy. It's a good thing for investors. It's a good thing for Main Street. It's a good thing for mom and pop. It's a good thing for everybody except for people who play around with a lot of debt, right? And just, want to kick the can down the road and kind of like, let other people take the losses if they screw up, right? So I think that this is very healthy. This is related to, I think, ending the Fed put. And I think it's part of like trying to rebalance the economy into a more productive and less financialized kind of mode.
Yeah,
right? And I think
when you have a risk adjusted return of zero or interest rate cost of capital is zero, companies and investors do stupid things.
Yeah, they do. Like they spend more time worrying about like boosting their stock price through stock buybacks than actually boosting their stock price through operating a good business, right?
Yeah, via execution. Yeah. Exactly.
Yeah, exactly. So, and I think that now that is going to change. And, I mean, for far too long, our economy has been essentially dictated by like stock prices and CEOs' stock options, right? And that's really all that's mattered, and everybody else has kind of gotten screwed, right? And now, I mean, look, we could get away with it because everything was being exported to China. I mean, jobs were being exported to China, and we were getting cheap stuff in return. So people could work at a place like Walmart and still afford to buy all that stuff they wanted to buy because it was cheaply produced in China. But that's also not sustainable either in the long term. And so now that you're seeing reshoring and COVID really, that I think we may see in the very long run, COVID is having created some positive fundamental changes in the economy. Like for one thing, reshoring supply chains, realizing how vulnerable these supply chains are.
Agreed.
If you have a just-in-time economy based on a supply chain that extends into China, and especially extended to some place with like, a political system that is unaccountable and can just like change on a whim, like that and doesn't have our best interests in mind.
They don't like us.
Yeah, exactly. Any stretch of the imagination, that's not a good position to be in, but it was driven by all of these factors like the financialization of everything, Wall Street being in charge of our economy. All that mattered was Wall Street bonuses and nothing else, right? And when you're in that situation, you wind up with, like the hollowing out of America, right? Because Wall Street would sell anybody, to sell their grandmother down the river if they can make a buck on it, right? So I think, I mean, I'm sounding very optimistic. I'm generally not a very optimistic person, but I mean, I'm hopeful that this is where we're going with this.
No, I think so. I think there's a couple of things that, if you look out a decade, right, you get out of the moment. I would assume reshoring is one of them. Certainly, there will be industries that CFOs outsourced because they wanted to get a couple of pennies on the bottom line. That was what was rewarded for decades. I think that changes. I think the use of technology and remote work is a net positive. People can move to cheaper areas, which obviously will have a detriment on the coasts, but probably gives a better quality of life when you average it out. I think there will be some positives when you look out at a decade. We just have a year or so of pain as we pay for the $9 trillion or whatever we printed, just the stimulus ballers and just all of this stuff we have to pay for, right? The hangover is real. I think the hangover is worse than people expect. But if you step out, look at the next decade, I think we're probably in a better space or a better spot than we are heading into it, I think.
If you even, with respect to, the example you just raised, which was the cost of living on the coasts, right? This also really relates to what the Fed has done over the last several decades, right?
Agreed.
Because what the Fed did was basically increase the demand for real estate, and that especially in areas where the supply couldn't grow, all you did was have more dollars chasing the same real estate, right? And then when you add to that the foreign money coming in, with cheap euros and cheap yen and cheap every other currency, right? Where and buying up housing on the coast, right? Because I deal with this with like my Japanese investor clients. You can show them an asset in an attractive market that they've never heard of, and they're like, no way, right?
No
I
way.
don't want to
Yeah.
touch it.
Yeah. I don't know where Boise, Idaho is, or
Right,
whatever.
exactly. But wherever it is, or even like, frankly, like outside New York City, right? Like right outside in the suburbs, right? They're like, I never
Right.
heard of that town, right?
Yeah. Yeah.
So
That's fair.
it really so they're all concentrated in those same areas, right? And this is all because of cheap money. So when you think about like people complaining about the cost of living in New York City and the West Coast and stuff like that, I mean, it's always been expensive, but the differential has grown dramatically because of what the Fed did, right? If they'd kept interest rates at a reasonable level, you would not have seen the same level of, just dramatic increases in home values that just price people out. And as much as people complain about taxes are actually a much smaller proportion of what people are dealing with than just the regular cost of housing, right? So that's been a big driver of like the cost of housing, the cost of living, financial inequality, right? It's, if you were on the ladder, the Fed just, raised your boat. All boats didn't rise, folks. That's what, I mean, I remember I took economics with Marty Feldstein, who, was Chicago school guy, famous economist. And he kept on talking about, and he was a monetarist back in the day before when the monetarists and the Keynesians were still battling it out, right? The monetarists were all like, we're just gonna, make money cheap and a rising tide will lift all boats. That's what I just remember him saying. A rising tide will lift all boats. It didn't. It lifted Wall Street's boats. It lifted the boats.
If you owned assets, it helped.
If you owned assets, it lifted your boats. If you didn't own assets yet, well, good luck trying to get your hands on some because it was getting more expensive by the day because the money was cheaper. So, and the Fed really, has to answer for that. And unfortunately, now what we're seeing is that, everybody got used to decades of cheap money. They bought into that whole system. It was unsustainable. Now the Fed is forced to raise rates and, take away the punch bowl, and it's going to cause a lot of pain, like you said. But the long-term effect of this could be positive in that the cost of housing is going to be, again, it's like in reverse. Like if you own the assets, well, you're experiencing pain now because the value of your home is falling. But like in the long term, this could be better for everybody because, if homes go back to being like where you live as opposed to a casino, that's good for the economy, right? And, people being able to buy homes and starter homes, that's good for the economy. It's good for stability. It's good for everything. It's good for society. So I would like to see us get back to that. And I think a key piece of that is interest rates that make more sense.
Agreed. Yeah. The last thing on a Fed pivot, I just want to put out here to kind of wrap this up is be careful what you wish for, right? I think the Fed is on a path. I think they need to do what they've been saying. I think they need to get us to 4.5. I'm thinking 5% terminal rate. Others say 4.5, close enough. Will it be there in 3 months or 6 months? I don't know. I think they have to get us there and then they have to hold. In order for us to get a rate cut, I think something bad has to break. And again, I will say, be careful what you wish for, because something bad breaking might be worse than the Fed staying flat for a year.
Yeah. And look, I mean, we've got a lot of conflicting data out there, and I'm reading, seeing what's happening here, but also looking at what's happening in Europe. Like people are still buying stuff like crazy. Like, I mean, we have there's been this technical recession with, I mean, there's so many different things that go into the calculation of economic growth. But if you look at like consumer spending, they're spending, right? They're continuing to spend, and profits are continuing to grow. Corporate profits are growing partially because they're raising, I mean, literally, they're raising prices so much, right? And so the economy is not in free fall by any stretch, even though you've got a lot of doomsayers out there saying like, oh, it's all, the world is falling, the sky is falling. The sky hasn't fallen yet, right? So I'm not saying that it won't, but I think that the Fed is not going to, sort of to your point, the Fed is not going to cut unless the sky really starts to fall, right?
Exactly.
So, yeah.
Yeah. Jonathan, where can people find you?
So if you would like to join my investor list, the best place to go is to Google Two Bridges Asset Management LLC, find the investor page on my website and fill it out. We only deal with accredited investors at this point, so I'm sorry for everybody else. But if you are accredited, please join the list and you will see the deals as they come. And if you would like to join my regular mailing list and get this free download, this is the ultimate checklist to get your first 100-unit deal with other people's money. This takes you through every single step I can possibly think of in the acquisition and syndication process. And if you just want to see like the overview of how these deals work, you can go to apartmentinvestorsclub.com and download this for free and get on my email list.
Awesome. Thank you so much.
You're welcome.